And welcome back, James McCallum and Dr. Carl Nackley, and hopefully
Good
Jose
to be
will
back.
join us from Venezuela. Uh, let's kick off, as always, on a Thursday with Dr. Carl, CEO of Crystal Energy. Carol, clearly there's many trends that we kick off the year with, and Europe being very much in the epicenter of them, whether it be geopolitics or the whole tightening cycle, the UK central bank sort of taking the lead. Let's kick off first with the tightening, the whole monetary policy issue, we look at the beginning of a year when the idea of money costing more, being more expensive as central banks try to catch up with inflation. How do you see that playing out in 2022?
Good morning, Sean. It's great to be back. Hello, everyone. Well, look, 2022 is starting in a very exciting way, in the sense that the action that we had before COVID, we're seeing more of it today, including geopolitics. But let me first talk about the macro side, and later we can go on to the geopolitics. On the macro side, the market has been prepared for the reaction we are seeing from central banks across, particularly the rich world, in Europe, in North America, in the US in particular. So we've been prepared psychologically for what is happening, because remember last year we kept on hearing about the term transitory for inflation. That was just a temporary thing. And then towards the end of the year, central banks realized that no, it's something that's going to last much longer than we thought. And therefore they had to take some actions, and they announced therefore tightening of their monetary policy, starting with tapering with their asset purchases. And then now we're talking about the increase in interest rate. Though again,
I have to interrupt you and just say the idea that the market has been expecting. It strikes me that everything about this is not that. The central banks were either in denial or incompetent most of last year, hanging on to some sort of nefarious idea of transitory. I don't even know what that means in inflation terms, but nonetheless, they strike me increasingly as incompetent, and the market is losing confidence in Jay Powell rather than building confidence as every week that goes by. No, it's not going to be any rate hikes. No, it's going to be 3. No, actually, it's going to be 4 next week. What is it going to be? That's not the way a central banker of the biggest central bank in the world should be chasing every week a new definition.
Well, look, definitely there are some people who are criticizing the central bank, but I wouldn't make it so dramatic and say that the market lost confidence. On the contrary, we don't see this kind of panicky reaction to announcements made by Powell or the Federal Reserve in the US, because again, we are starting from very low base in terms of increasing interest rate. Now, you do have completely different views with respect to what the central bank should have done. So on the one hand, you have those who support fully the policies that have been pursued, because they say, for example, you have Krugman, for instance, he described that what we had last year was like a situation of war. And during a situation of war, you cannot really think too much about to what extent will inflation damage economic growth, or whether you overdid it with your stimulus or with your monetary policy. And there are others who say, no, look, you have gone too far and you should have started tightening much earlier. But the point I'm trying to make, and of course, time will prove who's right, who's wrong. But the point I'm trying to make is that the central bank, to be fair to Jay Powell, he did take the market gradually. So there were no shocking surprises. There were no, people were not caught by surprise. They prepared the market. And like OPEC, right? They said that we're going to follow the progress in the market and take actions accordingly. And now we have clarity about what they want to do. The question is how many times they will increase interest rates, 3 or 4. We will see, but they will not, I'm pretty sure that they will not take actions that would destroy the growth we are seeing. But they are telling the market, the good thing is that they are telling the market, we have the remedy and we are using it to ease the inflationary pressure on you and on the market and on the people.
Let's go to Dublin. James McCallum, Executive Chairman of Exergy, Professor of Energy at Strathclyde University. James, I'm really glad that we have you on today. Any day is a great day to have you on, but nonetheless, a day in which the Permian oil output reports that the Permian oil basin, shale oil basin of the US has hit a new record. And
Mm.
I'm sort of very curious. You spent much of last year being somewhat negative about the outlook for the recovery of U.S. oil production. It does seem to be on a roll now. Your thoughts at the beginning of the year as to where the sort of the marginal oil production outside OPEC plus starts to return?
Yeah, I mean, to be fair, you're right to pick me up on that, Sean. You know, I was very down on the Permian, but then equally, I've not been as bullish as others have been on where the oil price would be at this particular point in the cycle. So the reality is we've seen some real discipline in terms of capital management in the big producers that are in the Permian, and it's now a big producers game. I think that's one part of the equation. You know, so there's been a lot of merger and acquisition activity that's seen the small guys out of the picture, and indeed it's the big producers who have been committing capital from production into recompletion activity, and that's a point which hasn't changed. The activity level which is yielding the increased production is all coming from completion activity or recompletion. It's not coming from new drilling or new capex investment, and that's the thing that we're still sitting waiting to see. I mean, certainly the EIA is predicting that there's still some room to go in terms of Permian production, and indeed the other shale basins as well, where it's not been quite as dramatic, but it's nevertheless seen an increase. I think the bit that I'm fascinated to watch at the moment is what will happen in terms of the lending environment with regards to the banks. This last week has been a really interesting week where we've seen quite a lot of contrast in the markets around, you know, messages coming out from the major players, the banks, etc., etc. And there's a couple of points which I'd like to touch on, and maybe we can get some good discussion on this. First of all, the financial results coming out of the banks have been relatively disappointing. You know, Goldman Sachs, etc., etc. Very disappointing results coming out of them. We've seen strong messages coming out of the Bank of America around their expectations in terms of increased activity in the Permian and other oil plays in the United States. But what we've not seen yet is the banks prepared to step back from the position which they have been saying, where, you know, lending into that sector, lending into oil and gas sector is not a place they want to be. Now, contrast that with the fact that if you take a look at the ramp up of share prices of BP and Shell over the course of the last 12 months, you know, or even over the last 6 months, up 30, 40% in terms of their share price. Now, you know, these are the companies that we have talked very specifically, Shell, BP, Total, in terms of their diversification agenda being where they're actually going. But those share price rises are undoubtedly a direct response to the rise in oil price. And the reason I say that is compare that to Ørsted, if you like, the former DONG, Danish oil and gas producing player who converted 100% to renewables. They are down 40% over the same 12-month cycle. So the reality is that what's actually happening in the market is even the big IOCs are seeing a lift in terms of their share price as a consequence of oil price. We're seeing an increase in production in the shale basins of the United States to respond to that oil price, but it's coming from completions, not new activity. Rig counts are still down significantly from the heady levels of 2014 to where they are now. Sorry? I've lost your sound there, Sean, I'm afraid.
These are drilled but uncompleted wells.
For the most part, they will be wells which have been completed in the past. The completions have failed and they've been waiting for workover activity. That's what that will be. That's actually driving that. And giving credit where it's due, that the producers have got better at that. The completion technology has improved, but this is not new capex. This is capex going into projects where the wells have been drilled and the wells are either being completed or being recompleted from a failed previous production cycle.
Carol, we touched on in the earlier comment the idea that there's many things driving the market as we start the new year, geopolitics being the big one. We've talked about it the last few days on the show, particularly in related to this region Abu Dhabi obviously suffering an attack at the beginning of this week. But most notably, comments overnight, a little bit shocking by the US president, essentially putting his hands in the air and acknowledging that Russia, according to the reporting at least, Biden has said and expects Russia to go into the Ukraine. The definition of in versus attack seems to be where the debate and the headlines are, but ultimately kind of resigned to the fact. Your thoughts on the ramifications of that, if indeed it does transpire? Is it going to be one of those, another Putin moment like we saw in recent years in Crimea? It sounds like a big noise in the headlines, but actually not.
Yeah, I scanned through what the speech of President Biden, but definitely it was pretty strong. And actually, Joe Biden, even though he's a soft-spoken Trump sometimes, you can see that there is no really love between the US and Russia. But when it comes to geopolitics, the main factor, if you ask me today about what's going on in the market, what's pushing prices, is primarily not only that, but also if you have ramifications elsewhere in other markets as well, you can see that the fear in terms of what could happen with Russia if Russia invades Ukraine or take over some parts of Ukraine, as Putin maybe has always wanted to do, then what will be the consequences on Russia? We are really sailing into a completely new territory, because the US had not only yesterday with Biden's speech, but before they referred to completely new sanctions, something unheard of before on Russia. And Russia is a major producer for natural gas, for oil. So what would that mean to supply disruptions in oil and gas markets? It remains to be seen, but really, I don't know. I mean, I don't know if I'm a bit in denial, because I had this conversation with some people who know a lot about Putin and Russia, and they seem to be pretty convinced that Putin will do it. And I'm struggling to see how he can risk such a big thing without thinking about the economic ramifications. Now, some would argue that he's been preparing Russia for shielding the economy from potential sanctions or a tightening of the sanctions, but how long can they sustain that situation without having further problems, including domestic problems or problems on their borders? So at the moment, the tensions we are seeing in Ukraine is having major ramification on oil markets. And of course, if the situation escalates further, then we're going to see a further escalation of prices. And I don't think it will be good news in the longer term for any producers, including Russia.
James, I welcome your thoughts on the same point, and just add the caveat on the last 2 points that Carol has made, that we start 2022 to a certain extent, in my opinion, with the markets a little bit numb or asleep at the wheel to the scale of these two challenges. The central banks losing control of the inflation story, which is not insignificant, 30-year highs in the UK and similar in the US. Chasing, only 3 months ago, we had a central bank saying, oh no, we're taper over 6 months. Then it was, no, we're taper over 3 months. We'll not do any rates. Now we're going to 4. I mean, and now on the east, in the Ukraine, the markets are barely acknowledging that this could be a major conflict in the center of Europe.
Yeah, there's no doubt about that. And I think
gas prices are actually falling the recent days.
Yeah, but what I was going to say was, the relationship of gas price and Russia is becoming acutely understood, particularly in the UK at the present moment in time. Look, the bankers I speak to are all pricing in, 3 or 4 rises over the course of this next year. But equally, they're also certainly through the first quarter still seeing upward movement in the markets. I think as we come to the end of the first quarter, beginning of the second quarter, that's when we'll need to sort of sit back and take a look at actually what's happening in terms of oil and gas. I come back to something I said earlier on, which I do pick up on this in terms of the tightness in the market between supply and demand, and where is, if you like, increased capacity going to come from. You talk about the speech that Biden made around Russia. There's also increasing talk this morning around him re-entering the conversation around compelling producers to produce more, whether it's in the United States or indeed in the Middle East. And the question there is who's got capacity to increase that production if indeed it's needed? Now, clearly that's, as you've said over the course of the last couple of days, contrasts markedly with the fall off in demand seen by the likes of Citibank or others, or indeed even the EIA as we go through the year. So you've got this real tightness here in the short term, the first quarter. You've got the EIA, you've got the banks sort of forecasting, if you like, a significant drop off in demand as a response to the inflationary pressure which you're actually talking about. But you've got relatively few people who can respond quickly to either movement in the market and bring additional production into play. And the bit that I'm watching with great interest is to see whether the financial institutes, the banks, the private equity market suddenly turn around and go, look, we've sat on the sidelines of oil and gas investment now for over a year. We're going to re-enter that market to bring CapEx potential into play, to increase supply and therefore exert control over those prices. But back to your Russia point, I think as gas prices tighten into the first quarter in the UK, as price caps to domestic consumers fall away or increase to new levels, we're going to see an increased European focus on what Russia intends to do.
It strikes me, Carol, that as we move forward into the year with this geopolitical equation, we also have the challenge of where this new supply comes from. And I'm curious, from your perspective, we've talked a bit about it in breakout sessions, where do marginal supply opportunities, Mozambique's, the others that have struggled to attract capital for development of reserves, where China is even retreating to a certain extent from Africa in terms of capital lending?
Sean, sorry, the sound is very low. I'm trying, but I feel my ear is getting bigger.
I just wanted to get your views on the point that James made there, that the idea that this year we will be facing the possibility of a CapEx coming back or not. And I'm wondering, from a marginal point of view, from the developing environments of the Angolas, the other marginal actors in Africa in particular, where even China appears to be withdrawing its provision of investment. Your thoughts on where that CapEx question plays out this year?
Yeah, first of all, I mean, what we have to think about, what is the relevance of the CapEx question today for today's market? Because mind you, when you think about investment in conventional oils, I'm not talking about shale, even shale takes like around 18 months to become more notable. But when you talk about CapEx today, you're really thinking about supplies over maybe after 7 years, perhaps, or 5 to 7 years, or 10 years even. So this is where I feel we're a bit lost in the discussion about CapEx, and people talk about investment gap, market tightening. They seem to be mixing different time frames together, because when we talk about CapEx today, it's investment after it's production after 5 years. Now, of course, CapEx is not as healthy as it used to be before COVID, or even better before prices started to collapse before that. But again, what we are seeing today, I would say, if I look at the market today, I would be thinking about the production that is coming as a result of capital expenditures that took place several years ago. And that's why this year, if you look at the IEA's latest report, whether you want to believe them or not, with all the credibility issue that they had recently, then you can see that we're going to see record increases in production coming from the US, but also from Canada, from Guyana, from other places where investment already took place in the past. Going back to other players such as Angola or Nigeria, I mean, these countries for years have struggled to attract investment irrespective of the oil price. And it's not because of what's happening in the macro environment or in oil prices, or they don't have a shortage of resources, but they simply had unattractive policies. Even Nigeria, when they did a final reform for their fiscal and contractual terms, they did the same mistakes as they had, for many years. And they did not really think about how we can bring in more investment to the country. They were only thinking about how we can squeeze more revenues out of the oil industry. So we have to distinguish between all these parameters when we're thinking about CapEx, because much more complicated than linking it to the oil price.
I would just like to challenge your thesis, though, a little bit on the idea that
you're challenging me a lot today, Sean.
I know what to do. You know, it is the beginning of the year. This is my New Year's resolution. Don't be so nice to Carol on Thursday morning.
Thank you. Oh, I love you for that.
The idea that the capex challenge is something in the future. My argument at the beginning of 2022 is that the future has arrived, and underpinning this rise to 90 and possibly 100 in the coming period is the fact that the capex thing, the lack thereof, is dawned. It is here, and we exist increasingly, and the great Christoph Ruhl highlighted it on Sunday, that we could be very soon at that point where there's only the sort of standard 2 million barrels of spare capacity in the world. We might get there sooner than I think even he articulated. So your thoughts on that challenge, that actually the capex piece, the lack of it in recent years, has now arrived, a consequence of which probably won't stop prices going above 100.
Everything is possible, Sean. Even the greatest Christoph Ruhl can get it right occasionally. But, again, I go back to the issue of how complex the whole topic is, because you talk about spare capacity, right? But we're forgetting about the growth in demand. So we cannot look at only what is the level of the spare capacity and what is happening outside OPEC in terms of growth of supply, but also what is the outlook for oil demand. I'm trying to square all these things in my mind because I find it too simplistic to narrow down the whole discussion about oil markets to only one criteria. Now, the point I'm trying to make is not that we have an issue with capex, of course, but we have to think also about improvement in efficiencies, for example. And that is another aspect, that you may be spending less, but you will end up translating whatever you're investing into more barrels, as we saw in previous situations where we had warnings about investment gaps, but that did not happen. The crisis in the market did not happen. But also I want to bring into the discussion, because I've been thinking about all this debate about prices hitting 3 digits. Well, if you look historically, if you take a much broader perspective than what you're looking at in terms of daily changes, you notice that when we had spikes in oil prices, especially if they were longer than usual, then the consequences of that is a much longer period of low oil prices. So this is something that we have to think about, not only focus only on when prices would hit the 3 digits, but what happens afterwards. And this is the result of supply responding and demand destruction.
I just want to bring James in on that point, as he made the comment earlier in the week in the chat room, that even if they go to turn on the switch, the supply chain may not be there as immediate as was previously envisaged. Your thoughts, James, again, even if we get the capex coming in, the ability to bring new capacity on quickly.
Yeah, no, and I was going to pick up on that point, Sean. So thank you. I mean, look, it's fascinating to me that the statistic which everybody focuses in on at the present moment in time is simply where oil price is right now, and indeed to give the listeners some context on that. One of the headlines today says, oil prices are now finally back at where they were in October 2014. Now, October 2014 is incredibly significant, because October 2014 is when the big recession in the oil and gas industry started to bite. Now, compare where, if you like, the OSX...
when you sold your amazing company 5 minutes before that happened.
There is never a substitute for good fortune and luck, Sean. The reality is, though, that if you compare to all the other service companies that are out there, the OSX index, which measures, if you like, service company performance, is down 77% on where it was in October 2014. So that gives you some context of where the big service players actually are in terms of investment into equipment and inventories, and indeed the health of those businesses. And many of them have actually gone. The rig count. Yeah, the rig count is at 25% of where it was at that particular point in time. Now, these are the material statistics which actually are about a healthy oil and gas industry. Now, couple that, as I said, to the point which I made earlier on, which is that during that period of time, the big IOCs have gone through an enormous shift in terms of strategy towards, let's call it, a diversified energy strategy play. So we've not even got the big players that existed in 2014 prepared to or even willing to return, despite the fact that certainly the boardrooms have been sitting there going, look, our share prices jumped more on the back of these oil price increases in the last 6 months than they have on any renewable investment that we've actually made. We need to be mindful of that. The market and the oil and gas industry is in a state of disarray right now. The major international oil companies don't know which way to move in terms of increasing shareholder return. The national oil companies, as you have rightly said, are very tight in their ability to supply, and really there's probably only two who can respond with an immediate uptick in production. So we have got this short-term tightening. We've got, as Carol quite rightly said, we've got this immediate tightening, which has been there for 7 years in terms of investment into the industry, and the industry cannot respond quickly, either into production or indeed from the service sector. It's just not possible.
Let's get the survey question in quickly before we close out our half hour together, which is sort of addressing this point where the optimism in the room is on US crude oil production. And the statement is US crude oil production will return to pre-COVID levels in 2022, i.e. 13 plus. Agree or disagree? Carol, I'll give you first bite at that cherry, because I know you've been articulating for some time great confidence in the return of shale, and here it is.
And yet it is returning because it's, again, basic economics, simple economics. Investors and producers will react to higher prices, and especially with shale, they can respond much faster. And to go to a point that James was making earlier about the structure of the industry, the big players not reacting in the same way they did before. But it's not, the industry is not just about the big players, at least not the European players, because you do have, especially in the shale industry, this much smaller and independent players who are not going to be restricted, or they are not following the same agenda or ambition as European players. And they are at the end the one who brought the shale revolution to reality, not the big companies. And therefore, with their aggressive appetite for investment, for making money, I think they can take this shale industry further. But also, just to add one more point to, again, widen the discussion to make people really think broader than what we're talking about. If you look at the share of spending, of expenditures of the major oil companies, even the most aggressive ones in Europe on climate change, how much they are spending on oil and gas and how much they are spending on renewable and green projects. And you can see it's not quite a reflection of what their CEOs are advocating publicly.
Let's give the survey result there and give James the last word. Agree. There's a lot of confidence now building in this shale production. James, your thoughts, again, just coming back to some of these, I didn't get a chance to hear from you on the geopolitical question. And in particular, I'm wondering, in your own views, inevitably, where these connect. We've got in Vienna, the nuclear talks, the Iran nuclear talks that are tangentially connected to what the incident that happened in Abu Dhabi earlier this week, in the sense that the Iran are the big protagonist. Then we've got the issue on the Ukraine border with Russia, and of course Russia are the biggest actor in the OPEC Plus tent, deciding on where oil prices are certainly having a big influence. Your thoughts on these geopolitical issues as we start out the year?
Yeah, look, the geopolitical dimension is the bit which is most difficult to call. The Iranian return, if you like, to the fold. There are actors playing out on both sides, and I was interested in the article again today around China entering the Vienna talks more dominantly to bolster up the bilateral agreement which they've had with Iran for some time. I've talked about that repeatedly, that China really wants to see Iran come back into the accepted production arena. And I think it will happen over the course of the year. I can't not pick up on a couple of points that Carol said there. And whilst I agree with her that we will continue to see, if you like, activity coming out of the producers in the Permian Basin that will pick this production up through the course of the next few weeks and early months of 2022. The independents in particular rely on finance from the banks. The banks have to date been not giving the smaller players access to that capital, whether it's in the form of from the private equity or indeed the lending markets. And I think we will begin to see a breakdown in that discipline. I think the reality is the banks, as I said at the beginning of the talk, off the back of very poor last quarter results, will begin to say we've got to get more returns in here. And the easy short-term fix on that is to bring on incremental production in the US, shale plays. So I think we will. That's what I'm monitoring. In terms of the point which Carol makes, in terms of let's not be blind to the improvements in efficiency, et cetera, that also requires investment from the major players because it's all digital, and the industry has to date been, if you like, a real laggard in terms of improving its digital efficiency. So I think we'll see investment into digital. I think we'll see the banks returning back to investment into conventionals as opposed to just simply diversified energy play. But I think it will be led by the independent community, because I think the big players like BP, Shell, and Total have shown their willingness to stay the course. The biggest offshore wind licensing round was announced last week in Scotland. 25 gigawatts of licenses given out, of which 6 are offshore wind farms, so floating wind farms for the first time. And who was leading the charge on all of that? BP, Shell, and Total. So we are in an incredibly interesting world, Sean, where we've got every single part of the, if you like, of the oil and gas matrix moving in different ways. And for me, I think the first quarter is going to be really exciting to watch how that begins to play itself out, including where the finance comes from.
Just to wrap up on that, again, coming back to the geopolitics, we've sort of existed in an oil market for a number of years where the sort of geopolitical premium, as it used to be referred to, has been out of the market because, of course, spare capacity has been so large for much of the last decade, really. Now we enter a period in which that spare capacity starts to shrink and the geopolitical tensions are rising, and so are going to have a much greater impact on the price in this year because of that reason. There just is no room for error. I would draw your attention for a review when you have time. We posted it in the digest today, the latest report from the International Rescue Committee on the 20 countries watch list for 2022. It really is sober reading, but it does tell you give you a great insight. There's some very serious stress in multiple countries, obviously Afghanistan, but to the scale of it, which of course has ramifications for neighboring countries, Iran and Pakistan. Ethiopia is unraveling, the Horn of Africa with the Yemen on one side and Ethiopia on the other. So these are significant developments, and I think it's very enlightened reading. I'd highly recommend it. But Carol, thank you so much. Great to have you back kicking off the year, anchoring the Thursday show. James, as always, thank you so much for your insights. Really appreciate it. Have a great day. We'll catch up with you next week, Sunday morning. Thank you so much.
Thank you, Sean. Bye-bye. Carol. Happy New Year to everybody. Bye-bye.